Something interesting happens every time trading gets harder. Panic spreads faster than information. Strong opinions appear before strong understanding. This time, the trigger is simple. The government increased STT, and suddenly the story is that options trading is dead. But markets don't die from headlines, they change from mechanics. STT stands for Securities Transaction Tax. It is not income tax. It is not capital gains tax. It is charged every time a trade happens. Whether the trade makes money, whether it loses money, whether it exits in panic or discipline, STT doesn't ask why you traded. It only confirms that you did. A good way to think about STT is a toll booth. You don't pay based on how far you travel. You pay every time you pass through. If traffic is light, the toll feels invisible. If traffic is intense, the toll changes behavior. You don't stop driving because tolls exist. You stop unnecessary trips. STT doesn't kill trading. It punishes movement without purpose. Let's remove emotion and look at numbers. Assume Nifty is trading near 25,000. One futures lot represents 25 units. That gives a contract value of roughly 6.25 lakh rupees. Earlier, STT on a futures sell was 0.02%. Now, it's 0.05%. That's an increase of around 187 rupees per contract per exit. Now scale that. If a trader exits 50 futures positions in a day, that's over 9,000 rupees in additional tax. Over a month, that approaches 2 lakh rupees. Not because the strategy failed, not because the market changed, but because activity was expensive. Options traders feel this more intensely because option trading is not about one trade, it's about adjustments. You sell, you hedge, you roll, you rebalance. Suppose you collect 1,20,000 rupees in option premium in a day. The STT has now changed drastically. That 60 rupee increase doesn't look scary alone, but repeat it across multiple legs, across multiple days, across multiple weeks. This isn't a dramatic collapse, it's erosion. Most traders don't blow up spectacularly. They don't wake up bankrupt overnight. They slowly bleed. Costs don't announce themselves, they accumulate. STT is not a heart attack, it's internal bleeding. And internal bleeding is dangerous because you feel fine until you don't. Now let's talk about what everyone's very worried about: liquidity. Options markets rely on constant participation. Market makers, scalpers, arbitrage desks, they keep spreads tight. When trading becomes more expensive, some participants step back. Spreads widen, slippage increases. This creates a second cost. One cost is the tax you see, the other is the execution damage you don't. STT increases friction in places most traders never look. Yes, FIIs and DIIs running algos are affected too. They pay the same STT, no special treatment. But survivability is different. Retail algos operate on thin edges and high frequency. Institutional algos operate on scale, infrastructure, and execution quality. When costs rise, retail algos bleed faster, institutions adapt. They don't stop trading, they trade less. They wait for better signals. They disable marginal strategies. Micro trades disappear. What remains is intent. STT doesn't kill algos, it kills algos that survived only because trading was cheap. Now let's compare India to various other countries. In the United States, there is no transaction tax. They tax profits alone. In the United Kingdom, stamp duty appears only on equity delivery. Derivatives are untouched. Japan removed transaction taxes decades ago. India is different. India taxes participation itself. This is a conscious design choice. The problem that India has is that it has massive retail participation. STT is simple to collect, difficult to evade, easy to administer. This isn't about global best practices. It's about stability and control. The casino stays open, but entry is no longer cheap. So, did Nirmala Sitharaman kill options trading? No. She raised the cost of being careless. Markets didn't get harder, they got less forgiving.